Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, July 20th, 2026. Last week, real dichotomy. The economic info that we got last week should have been quite favorable to financial markets, but as you'll see, equity markets did not do well in the U.S. last week, despite good economic news. So we'll go through those data points and explain why the equity markets performed poorly in the U.S. last week. In terms of economic information, the key indicator metric looking at right now, certainly inflation. And we had really good news on the inflation front last week. Starting on Tuesday, we had the CPI report, and both the headline number and the core much better than expected. In terms of month over month, the headline number was expected for June to be down minus 0.1%. It came in minus 0.4%. And the core inflation rate was expected to come in at a positive 0.2%, but came in flat. The next day, we had PPI, or Producer Price Index, and both the core and the headline numbers also came in better than expected. So for the headline number for June, month over month, it was expected to be flat month over month, but it actually declined 0.3%. And then the core month over month was expected to be up 0.4, but came in only 0.2. So very favorable news on the inflation front from CPI and PPI. Finishing off with last week, we also had initial jobless claims that came in really strong. This has been just a wonderful underreported story. The expectation was 217,000 new initial claims, came in at 208,000. Same day, we got decent news on retail sales. Now, retail sales, we certainly don't want to see it super strong at this point, which would suggest potentially inflation, but we really don't want it negative either, meaning the economy is decelerating. And we got exactly that last week. So the headline number, retail sales for the month of June, was expected to be up 0.2% month over month. That's where it came in, positive 0.2. Ex-automotive, a little bit different, not terribly bad, but the consensus was coming in at negative 0.1 and came in at negative 0.2. So we would say this data point, retail sales, also a positive last week. And then on Friday, we had kind of throwaways for us, two housing metrics, forget those. Michigan consumer sentiment, which I had promised never to talk about again, but it showed up on my slide, so I will. It was actually positive. Now, this has been hugely negative over the last 18 months. When I say negative, it's been declining and much faster than the consensus had expected. So for the month of July, the expectation was it was going to be roughly flat at 51. Way to the upside surprise, it came in at 54.4. But we'll stand by what we've said in previous weeks and months. It really doesn't do anything predictive-wise. So a few other metrics from last week. Inflation expectations unchanged. Expectation for the next 10-year in terms of average inflation, 2.24% based on the 10-year break-even calculation. GDP growth for the second quarter, which finished on June 30th. The Atlanta Federal Reserve actually increased their expectation from 1.3% to 1.7%. That would be a very solid result. Recall the first quarter was a positive 2.1%. In terms of what the Fed might do, we do have a Fed meeting yet this month, next week, I think. And the expectation has been coming down about a rate hike. So now there's 16% expectation of one rate hike. I think it's pretty unlikely that's going to happen. And expectations for the end of the year in terms of rate hikes, that's also coming. So in terms of what the expectations are for no cut or increase or raise, 17%. But now 42% probability of one rate hike. That was only 33% last week, but that came at the expense of the other rate hike tranches here. Two rate hikes, the probability is now 31%. It was 37%, and then three or more. Last week, that was 18%. It dropped to 9%. So takeaway here is the expectation for rate hike by investors through the end of the year decreased last week. So it's all good news. And lastly, we'll just talk about corporate earnings. Just started in the second quarter earnings cycle. The financials start off. They're always the earliest reporters. We now have 10% of S&P 500 companies that have reported. 88% have beat estimates, way above the 5 or 10 or 20 or 100-year averages. So super strong, no question about it. And those that reported and beat were 16.4% above estimate. So the companies that are beating by wide margins. So that's way above, again, the 5 and 10-year averages. Last week, the financials definitely led the earnings results for the S&P 500. On the negative side was healthcare, which actually had downward revisions. Otherwise, earnings look really healthy for the S&P 500. But the only thing we would say about that is last year, certainly corporate earnings is what kept the stock market up. Corporate earnings have only accelerated this year, but also what has accelerated is expectations. So quarter to date, those 10% of the companies that have reported, if you extrapolate that out through the rest of the earnings cycle, that would be the 24.7% earnings growth year over year, which is fantastic. But given expectations, at the end of June, we're 23.2. So companies are beating by a large magnitude. However, it's not much better than what the consensus expected. So if companies start to falter, if we start to see some slowing in corporate earnings, would decidedly be negative for equities in the U.S. So let's take a look at the returns from last week. And again, we preface this by saying equity returns in the U.S., not great last week. S&P 500 down 1.6%. What really happened last week, what turned things around, is midweek, maybe Thursday, a Chinese startup, Moonshot, had announced an AI model that competed well against the U.S. versions, Anthropic and OpenAI, but they weren't going to charge for it. So investors, super concerned, didn't sell the AI companies themselves necessarily, but sold semiconductors hard. So the very next day, Alibaba came out with an announcement that their new AI model is even better than Moonshot. So further pressure on U.S. semis. In total, last week, the Philadelphia Semiconductor Index was down an even 10%. So growth last week in the U.S., growth stocks were down 4.1%, large cap stocks down 1.9%. In terms of international, developed markets ex-U.S., almost flat. It was down 55 basis points, not great. But emerging markets hit hard. They were down 4.1%. Emerging markets ex-China, if we just strip that out, is really driven by South Korea and Taiwan. And for South Korea, technology stocks are over 50% of that index. And for Taiwan, it's over 70%. So the same thing that hit the U.S. market last week, the weakness in that Philadelphia Semiconductor Index, hit both Taiwan and Korea last week, leading to emerging markets again down 4.1%. Fixed income in the U.S., slightly positive last week. We had the 2-year yield down 3 basis points, the 10-year down 1 basis point. So the Bloomberg U.S. Aggregate Bond Index was up just slightly, 0.13%. And almost the exact same number is the year-to-date return, positive 0.16%. This week, economic activity to be reported. Thankfully for me, not much is going to happen. On Thursday, we do get initial jobless claims. Recall, last week was really low, 208,000. Expectation is 212,000. On Friday, we get 3 home start related metrics. Again, these just don't move the market, might move some individual stocks. But in total, slightly negative. Building permits are expected to be down a little bit from the month of June, month over month and year over year. But new home sales are expected to be slightly better in June than they were in May. May they were 580,000, expected to be 610,000 for the month of June. So that's it for our recap this week. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.